The American housing market has always been more than just numbers. It reflects the hopes, fears, and decisions of millions of families, investors, and policymakers. Over the last few years, it has undergone some of the most dramatic changes in modern history. From record-low mortgage rates in 2020 to the sharp rise in interest rates after 2022, from booming suburban demand to affordability crises in major cities, the story of U.S. real estate is a mirror of the nation's shifting economy. Imagine a family in Florida. In 2021, they could buy a new home with a mortgage rate under 3%. Just 2 years later, those same buyers faced rates above 7%, cutting their purchasing power nearly in half. This single factor reshaped demand nationwide, influencing prices, inventory, and the way people think about buying or renting. And it's not just homeowners who feel the impact. Landlords, builders, and investors are recalculating every step. Today, Florida stands out as one of the most closely watched markets. With rapid population growth, steady migration from other states, and a thriving job market, the state has become both a magnet for new residents and a test case for affordability challenges. Cities like Miami, Tampa, and Orlando have seen property values soar, but at the same time, rising insurance costs and limited housing supply have created new pressures. Nationally, the story is complex. In some regions, home prices remain near record highs. In others, especially where affordability has hit a ceiling, the market is cooling. Renters, too, are facing rising costs, with monthly payments stretching household budgets. For investors, questions about returns, stability, and risk are sharper than ever. Yet, this turbulence also brings opportunity. Market corrections, shifting demographics, and emerging trends, such as remote work reshaping demand for suburban and rural homes, are opening new strategies for those who can read between the lines. While headlines often focus on extremes, housing crash, or unstoppable boom, the truth lies in careful analysis of local conditions, interest rate policies, and consumer behavior. As we explore the U.S. housing market, we will look at key questions. What drives prices up or down? How do interest rates directly change buying power? Why are states like Florida leading population growth? And what does that mean for investors? Most importantly, what should everyday buyers, sellers, and renters expect in the near future? This journey is not about predictions alone. It's about understanding the forces that shape where Americans live, how they invest, and how the market adapts to uncertainty. Whether you are a first-time homebuyer, a seasoned investor, or simply curious about real estate trends, the story of the U.S. housing market is one that touches us all. 1. Northport, Florida. With a median home price of $395,000, Northport has experienced one of the sharpest downturns in the U.S. housing market, showing an 11.4% year-over-year decline. For a city that, not long ago, was among the hottest destinations for retirees and new residents seeking affordable coastal living, this sudden reversal tells a larger story about Florida's changing real estate landscape. The main culprit behind Northport's price drop is not simply supply and demand, but the growing burden of living in Florida itself. Over the past few years, the cost of homeowners insurance in the state has skyrocketed, in some cases doubling or tripling. Insurers are pulling out of Florida or sharply raising premiums due to repeated natural disasters, including hurricanes, flooding, and storm surges. For many homeowners, this makes staying in Florida financially unsustainable. Even potential buyers who fall in love with the area are discouraged when they realize that annual insurance bills can reach tens of thousands of dollars, adding significantly to the cost of ownership. On top of the insurance crisis, climate risks loom large in buyers' decisions. Northport, located in Sarasota County, sits in a region that has been repeatedly hit by hurricanes. Memories of Hurricane Ian, 2022, are still fresh. Northport was one of the hardest-hit cities, with homes and infrastructure severely damaged. For families and investors, the prospect of buying into an area where future storms are all but guaranteed creates hesitation. As one real estate agent recently put it, you're not just buying a house in Northport, you're buying into the risk. Another factor is the broader migration shift happening across the country. During the pandemic, Florida was one of the top destinations for Americans seeking warmer weather, lower taxes, and more space. Northport saw a surge in newcomers, pushing prices rapidly upward. However, as the cost of living has risen, combined with overcrowding in some areas, a portion of those same people are now leaving Florida. States like Tennessee, North Carolina, and Texas are increasingly attracting former Floridians who want lower insurance premiums and less exposure to climate disasters while still enjoying relatively affordable housing. Despite these challenges, Northport is not without its strengths. The city still offers a relatively low median home price compared to nearby Sarasota or Naples. Its natural amenities, including proximity to beaches, parks, and warm weather year-round, remain attractive for retirees and those seeking a quieter lifestyle. However, these positives may not be enough to counterbalance the financial and environmental risks that define life in coastal Florida. Looking ahead, real estate experts caution that unless the insurance crisis is addressed and stronger climate resilience measures are taken, markets like Northport will continue to struggle. Investors may see opportunities in the downturn, but long-term stability will require systemic changes that go beyond simple supply and demand. In short, Northport's minus 11.4% decline is more than just a market correction. It's a warning sign about the sustainability of Florida's housing market as a whole. 2. Austin, Texas. Median home price, $460,000. Year-over-year decline, minus 9.2%. For much of the past decade, Austin, Texas, was considered one of America's hottest housing markets. Fueled by a booming tech industry, a young and growing population, and an influx of new residents seeking lower taxes and a vibrant lifestyle, the city earned a reputation as the Silicon Hills of the South. Home prices soared at an extraordinary pace, especially during the pandemic years, when remote workers and tech employees from California and other high-cost states flocked to Austin. But in 2025, the story looks dramatically different. After years of rapid appreciation, Austin's housing market has cooled noticeably, with median home prices falling by 9.2% year-over-year, one of the sharpest drops among major U.S. metro areas. The correction has raised questions. Was Austin's housing boom built on fundamentals, or was it a bubble waiting to burst? Several factors are contributing to this slowdown. First, the city's rapid population growth has started to level off. While people are still moving to Austin, the pace has slowed, partly due to rising costs of living that now mirror many of the coastal cities newcomers were trying to escape. Rents remain high, property taxes have climbed, and homeowners are grappling with affordability issues that challenge the city's once attractive, affordable alternative narrative. Second, the tech sector, the very engine that propelled Austin's housing boom, is facing turbulence. Large employers like Meta, Amazon, and local startups have scaled back hiring, frozen expansions, or laid off workers. This has weakened demand for housing at a time when supply is finally catching up. Developers, encouraged by years of high demand, built aggressively, and now many new units sit on the market longer than expected. Third, rising interest rates have dampened buyer enthusiasm. During the ultra-low interest rate environment of 2020 to 2021, homes in Austin often sparked bidding wars, selling well above asking prices. Today, with mortgage rates hovering at higher levels, monthly payments for the same homes are substantially more expensive. Combined with falling home values, many potential buyers have adopted a wait-and-see approach, anticipating further price corrections. The cooling market has also exposed the challenges of speculation. Investors who purchased properties expecting endless appreciation are now retreating, selling at losses, or holding vacant units. For local residents, this shift brings a mix of relief and concern. Relief that prices are no longer skyrocketing out of reach, but concern that a deeper downturn could destabilize the local economy. Despite the decline, Austin's fundamentals remain strong in the long term. The city still offers a dynamic cultural scene, a growing university presence, and no state income tax, factors that continue to draw interest from businesses and individuals alike. However, the near future suggests a period of recalibration. Austin is moving from a frenzied boomtown to a more balanced, and perhaps more sustainable, housing market. In short, Austin's housing slowdown reflects the natural consequence of years of overheated growth. The market is not collapsing, it is correcting. For buyers, this may be a rare opportunity to enter a city that once seemed untouchable. For sellers, however, The reality is sobering. Austin's golden housing era has cooled, at least for now. 3. Lakeland, Florida. Median home price, $315,000. Decline, minus 8.7% YOY. Lakeland, a mid-sized city located between Tampa and Orlando, was once seen as a prime destination for families and retirees looking for affordability, sunshine, and proximity to larger urban centers. For years, it benefited from Florida's population boom, drawing in both locals and out-of-state buyers seeking a more affordable alternative to Miami, Tampa, or Orlando. However, recent trends show that Lakeland's housing market is losing momentum. With home prices now down nearly 9% year-over-year, the city is facing challenges that are reshaping its once thriving real estate landscape. The primary reason behind Lakeland's cooling market lies in the rising cost of living. While it was previously marketed as a budget-friendly alternative, the city has experienced sharp increases in utility costs, groceries, and especially property insurance. Florida's ongoing insurance crisis, fueled by natural disaster risks such as hurricanes and flooding, has made owning a home in Lakeland far more expensive than it once was. What used to be a refuge for middle-class families is now becoming less affordable, eroding one of its key selling points. At the same time, the influx of new residents during the pandemic put tremendous pressure on Lakeland's infrastructure and services. Roads, healthcare facilities, and schools have struggled to keep up with demand, leaving long-term residents frustrated. Some new arrivals, initially attracted by the city's location and affordability, are finding that the quality of life doesn't match the promises. This has slowed demand, creating downward pressure on housing prices. The labor market also plays a role. While Lakeland benefits from its proximity to larger job markets in Tampa and Orlando, its local economy is not as diverse or dynamic. Many workers still commute long distances, and rising fuel and transportation costs are making that lifestyle harder to sustain. Younger professionals and families who once saw Lakeland as a convenient compromise are reconsidering whether the trade-offs are worth it. Investor behavior has further amplified the downturn. During the height of the housing boom, Lakeland was a hotspot for investors looking to purchase rental properties. However, as rents stabilize and home values decline, investor interest has cooled. This has reduced competition in the market, allowing prices to slide further. Without the strong presence of cash buyers, homeowners are struggling to sell at the prices they expected just a couple of years ago. Looking ahead, Lakeland's real estate market may continue to soften unless the state can address the insurance crisis and ease the cost of living burden. The city still has location advantages. Its position between Tampa and Orlando remains attractive, but the very factors that made it appealing are now working against it. If affordability continues to erode, Lakeland risks losing its status as a desirable alternative for families and retirees, cementing its place among the hardest-hit housing markets in the country. 4. Boise, Idaho. Boise, the capital of Idaho, has long been celebrated for its scenic beauty, affordable lifestyle, and reputation as a rising star among mid-sized American cities. During the COVID-19 pandemic, this once quiet city experienced a housing boom unlike anything in its history. Fueled by an influx of buyers from larger metropolitan areas, many of whom were eager to escape expensive markets such as San Francisco, Seattle, and Los Angeles, Boise's housing market skyrocketed almost overnight. Homes that once sold for modest prices were suddenly commanding offers well above asking, often within days of listing. At its peak, Boise was repeatedly named one of the fastest-growing housing markets in the country. Median home prices surged to over $445,000, far beyond what many long-term residents could reasonably afford. The promise of wide-open spaces, strong job opportunities, and a more relaxed lifestyle drove demand, and builders struggled to keep up. However, what goes up quickly can often come down just as fast, and that is exactly what has happened in Boise. In the last year, Boise's housing market has seen a sharp reversal. Home prices have fallen by minus 8.1% year-over-year, signaling a dramatic cooling. The reasons for this downturn are multifaceted. First, as the pandemic subsided and remote work flexibility diminished, many newcomers found themselves tied once again to larger urban centers. This shift reduced the stream of buyers relocating to Boise, leaving the market oversupplied compared to the frenzied demand of 2020 and 2021. Second, mortgage rates have surged across the U.S., making homeownership far more expensive. For many middle-income families, the monthly payments on a $445,000 home at current interest rates simply no longer fit within budget. This affordability squeeze has discouraged first-time buyers and slowed investor activity, both of which had previously fueled Boise's rapid growth. Another contributing factor is the economic reality faced by longtime Boise residents. While the city has grown in popularity, wages have not kept pace with housing costs. Many locals who were priced out during the boom are unwilling or unable to purchase now, even with recent price declines. This creates a paradox. Homes are technically cheaper than they were at the peak, but still unaffordable for many who live and work in Boise. As a result, the once white-hot market is experiencing longer listing times, fewer bidding wars, and increased negotiation leverage for buyers. Sellers, who were accustomed to the idea that their homes would fetch top dollar in days, are now forced to adjust expectations. Some have pulled properties off the market entirely, preferring to wait rather than accept a lower price. Despite the downturn, Boise is not without potential. Its natural beauty, growing reputation as a hub for outdoor enthusiasts, and relatively low cost of living compared to coastal markets remain strong draws. Analysts suggest that once the market stabilizes, Boise may still prove to be a long-term winner. However, in the short term, the city stands as a prime example of how quickly a housing market can shift from boom to bust when external factors, rising rates, shifting work trends, and affordability challenges collide. 5. Cape Coral, Florida. Cape Coral, located along Florida's Gulf Coast, has long been a popular destination for retirees, seasonal residents, and families seeking a warm climate, waterfront living, and relatively affordable homes compared to larger Florida metros like Miami or Tampa. However, the housing market in Cape Coral has recently taken a noticeable downturn. The median home price currently sits at $375,000, reflecting a 7.9% year-over-year decline. Several key factors contribute to this cooling trend, most notably the rising costs of home insurance and the lingering impacts of natural disasters. One of the biggest challenges facing Cape Coral's real estate market is the increasing risk of hurricanes and tropical storms. Hurricane Ian in 2022 caused significant devastation across southwest Florida, and Cape Coral was one of the hardest-hit cities. While much of the community has been rebuilt, the storm served as a stark reminder of the vulnerability that coastal communities face. This heightened perception of risk has discouraged some potential buyers, especially those coming from out of state, who may not want to take on the uncertainty of frequent natural disasters. Adding to this issue, home insurance premiums in Florida have skyrocketed. In Cape Coral, many homeowners are now paying several $1,000s per year just to insure their properties. Some insurance companies have even pulled out of the Florida market altogether, leaving residents with fewer options and higher costs. For prospective buyers, these rising expenses can significantly impact affordability, even if the listing price of a home appears within reach. Another factor cooling Cape Coral's housing market is the broader economic environment. Mortgage rates remain elevated compared to the record lows seen during the pandemic, which makes financing a home purchase more costly. Buyers who may have been eager to move to Florida 2 or 3 years ago are now reconsidering, given that monthly payments are substantially higher at today's interest rates. This shift in demand has directly contributed to slower sales activity and declining home prices. Despite these challenges, Cape Coral still holds appeal for certain buyers. The city is known for its extensive canal system, often earning it the nickname Waterfront Wonderland. Many homes have direct water access, making the area especially attractive to boating and fishing enthusiasts. Additionally, the cost of living in Cape Coral, while rising, can still be lower than in larger metropolitan areas across the United States. For retirees with cash savings or individuals seeking a second home, the current market decline could represent an opportunity to buy at a relative discount. Looking forward, Cape Coral's housing market will likely remain influenced by external pressures, particularly climate risks and insurance affordability. If insurance premiums stabilize and buyers adjust to higher mortgage rates, demand may gradually recover. However, If severe storms continue to batter the region and costs keep rising, the market may struggle to regain the momentum it enjoyed during the pandemic housing boom. In conclusion, Cape Coral illustrates the delicate balance between natural beauty and natural risk. While the market has cooled with a 7.9% price drop, the long-term outlook will depend heavily on how Florida addresses its insurance crisis and how buyers weigh the trade-offs of living in a coastal paradise with inherent vulnerabilities. 6. Phoenix, Arizona. Phoenix has long been one of the most attractive destinations for homebuyers, investors, and retirees alike. Known for its warm climate, expanding job market, and relatively affordable housing compared to California, the city experienced tremendous growth in population and real estate demand over the last decade. However, like many booming housing markets across the United States, Phoenix is now undergoing a significant cooldown. With the median home price sitting at $420,000 and showing a 7.4% decline year over year, the city exemplifies how high interest rates and affordability issues are reshaping the housing landscape. The drop in home prices can be traced primarily to weakened demand. Mortgage rates have more than doubled from their historic lows in 2020 to 2021, and this has priced out a large segment of would-be buyers. For first-time homeowners, in particular, monthly payments have become prohibitively expensive. As a result, many potential buyers are choosing to wait on the sidelines, hoping that either interest rates will fall or housing prices will dip further. This reduced buyer activity has left sellers with fewer offers and forced some to lower their asking prices in order to attract attention. Investors, once a major driving force behind Phoenix's real estate surge, are also retreating from the market. During the pandemic, institutional buyers and short-term rental investors flocked to the city, drawn by its rapid population growth and potential for high rental yields. But with declining home values and stricter regulations on short-term rentals in some neighborhoods, many of these investors are pausing new acquisitions or even offloading properties. Their exit has contributed further to the softening of prices. Despite this slowdown, Phoenix still retains long-term strengths that make it an appealing housing market. The city continues to grow in population, driven by people relocating from more expensive states such as California, Washington, and New York. Its job market, particularly in sectors like healthcare, technology, and manufacturing, remains robust. Moreover, Phoenix offers a lower cost of living compared to many coastal cities, even if affordability has become more strained in the short term. Another factor influencing the housing market is the region's extreme climate. Phoenix's scorching summers, with temperatures frequently exceeding 110 degrees, are increasingly shaping buyer preferences. Concerns about water supply and rising utility costs are also beginning to affect demand, especially among environmentally conscious buyers. These climate challenges could play a greater role in determining the long-term sustainability of growth in the city. Looking ahead, the Phoenix market is likely to remain in a state of adjustment throughout 2024. If mortgage rates begin to ease, demand could rebound more quickly, given the underlying strength of the region's demographics and job growth. However, if rates remain elevated, the current buyer hesitation could persist, leading to further modest declines in home prices. In conclusion, Phoenix is a clear example of how rising borrowing costs have cooled one of America's hottest housing markets. While the city still holds long-term appeal, the near-term outlook remains cautious. Buyers may see more opportunities as prices soften, but affordability challenges continue to be a defining feature of Phoenix's real estate story. 7. Las Vegas, Nevada. With a median home price of $405,000, the Las Vegas housing market has seen a 6.8% year-over-year decline. Known for its volatility, this market is now showing clear signs of stress as broader economic pressures intersect with local challenges tied to tourism and services. Las Vegas has long been considered a boom-and-bust city. Its housing market, much like its economy, is heavily tied to external factors such as consumer spending, travel, and employment in the leisure and hospitality sectors. During periods of strong economic growth, the city attracts investors, retirees, and workers alike, pushing home prices upward at a rapid pace. However, when the economy slows, Las Vegas is often among the first to feel the pain. That is what is happening now. The decline of nearly 7% in home prices is significant, especially considering that just 2 years ago, Las Vegas was one of the hottest housing markets in the nation. Post-pandemic demand, fueled by low interest rates and an influx of remote workers seeking more affordable housing compared to California, drove a sharp surge in property values. But today, the conditions have shifted dramatically. One of the biggest pressures comes from weaker demand. Mortgage rates remain elevated, and many potential buyers have stepped back from the market, either unable or unwilling to take on the higher monthly payments. For a market like Las Vegas, where a large percentage of buyers are investors or second home purchasers, the sensitivity to interest rates is even greater. When borrowing costs climb, speculative buying slows almost immediately. The second factor weighing on the market is the slowdown in tourism and hospitality. Las Vegas thrives on its reputation as an entertainment capital, drawing millions of visitors every year. Tourism supports a wide range of jobs, from casinos to hotels to restaurants. When visitor numbers dip, whether due to economic uncertainty, reduced discretionary spending, or global issues like rising travel costs, the local job market feels the impact. Weaker employment and income growth in turn reduce the number of qualified homebuyers. Additionally, the local economy's reliance on service-oriented work creates a fragile balance. Many households in Las Vegas work in jobs that are highly sensitive to economic cycles, making them more vulnerable to downturns. This volatility translates directly into housing demand. Unlike markets with strong and diverse job bases, such as Austin's tech hub or Washington, D.C.'s government-driven economy, Las Vegas struggles to maintain stability during national economic slowdowns. Looking forward, analysts caution that the Las Vegas housing market could remain under pressure for the next year if interest rates stay high and tourism doesn't fully rebound. Investors who once flocked to the city for quick returns may now be pulling back, creating more inventory and softening prices further. Still, opportunities exist. For buyers who were priced out during the pandemic surge, today's market offers more breathing room and negotiation power. Sellers, however, face the reality of longer listing times and increased competition. In a city built on risk and reward, Las Vegas real estate continues to embody both. 8. Palm Bay, Florida. With a median home price of $310,000 and a 6.5% year-over-year decline, Palm Bay has become one of the many Florida markets experiencing noticeable corrections. Once regarded as a relatively affordable and fast-growing community within the Sunshine State, Palm Bay is now showing signs of stress in its housing market, reflecting both statewide and national trends. Florida as a whole has long been a magnet for new residents, retirees, and investors. Its lack of state income tax, warm climate, and vibrant lifestyle made it one of the hottest destinations during the pandemic-era migration boom. Cities like Palm Bay benefited from the influx of remote workers seeking more space and affordability compared to major metropolitan areas. Home prices surged dramatically as demand outstripped supply. However, the story is changing. The recent decline in Palm Bay's housing market is tied to multiple factors. First, higher mortgage rates have weakened buyer demand across the board. With borrowing costs nearly double what they were just a few years ago, many potential buyers are priced out. Homes that once seemed like bargains in Palm Bay no longer look as attractive when monthly payments have risen significantly. Second, Florida faces the burden of soaring homeowners insurance costs, which are particularly severe in coastal and hurricane-prone areas. While Palm Bay is not directly on the ocean, it is still affected by statewide risk factors that insurers take into account. After a series of destructive storms and mounting claims, insurance premiums have climbed to unprecedented levels. For many buyers, the added expense of insuring a property in Florida has become a deal breaker, pushing them to reconsider or delay home purchases. Additionally, Palm Bay is facing the challenge of overbuilding and speculative buying during the pandemic boom. Investors and developers rushed into the market when prices were climbing rapidly, but with demand cooling, many properties are sitting longer on the market. This oversupply is now pressuring sellers to cut prices to attract qualified buyers. Despite the downturn, Palm Bay retains long-term appeal. Its affordability compared to nearby coastal cities like Melbourne and Palm Beach still makes it attractive to some buyers, particularly retirees seeking a quieter lifestyle. The city also benefits from proximity to Florida's Space Coast, a region experiencing growth in aerospace and defense industries. Job opportunities in these sectors could help stabilize housing demand over time. Yet, in the short term, Palm Bay's housing market is expected to remain under pressure. Economic uncertainty, high interest rates, and persistent insurance challenges create headwinds for recovery. Unless there is meaningful relief in borrowing costs or state-level reforms to address insurance affordability, the correction in Palm Bay and Florida overall may continue. In summary, Palm Bay serves as a microcosm of Florida's broader housing struggles. The city's 6.5% annual decline reflects a mix of local vulnerabilities and statewide issues that are cooling what was once one of the hottest real estate markets in the country. While Palm Bay may regain momentum in the future, buyers and investors are currently approaching with more caution, waiting for conditions to stabilize. 9. Tampa, Florida, from red-hot market to cooling trend. Not long ago, Tampa was celebrated as one of the hottest real estate markets in the United States. During the pandemic housing boom, the city attracted waves of new residents, investors, and remote workers, all eager to claim a piece of the Florida lifestyle. With its vibrant economy, sunny climate, and no state income tax, Tampa was positioned as an ideal place to relocate. Homes were selling quickly, often above asking price, and bidding wars became the norm. However, the momentum has shifted dramatically. As of this year, the median home price in Tampa stands at $410,000, marking a 6.2% year-over-year decline. While this may not sound catastrophic, it is a notable reversal for a market that had seemed unstoppable. The downturn reflects a broader cooling across Florida, where cities that once experienced explosive growth are now facing the realities of affordability, insurance costs, and economic pressures. One of the most significant factors weighing on Tampa's housing market is affordability erosion. Prices skyrocketed between 2020 and 2022, leaving many local buyers priced out. Even though prices have started to soften, higher mortgage interest rates mean that monthly payments remain burdensome. For example, a buyer looking at a $410,000 home today faces much steeper financing costs than a buyer 2 years ago, even at a lower purchase price. This has discouraged many first-time buyers, reducing demand. Another challenge is Florida's rising home insurance crisis, which has hit Tampa particularly hard. Severe weather risks, especially hurricanes and flooding, have pushed insurance premiums to record highs. Some insurers have even withdrawn from the Florida market, leaving homeowners scrambling for coverage. For prospective buyers, the added cost of insurance makes homeownership significantly more expensive, further cooling enthusiasm. Additionally, Tampa's once frenzied investor activity has slowed. During the boom, institutional investors and short-term rental buyers flocked to Tampa, driving up competition. Now, as rental demand normalizes and profit margins shrink, many investors are retreating. This withdrawal reduces overall demand and puts downward pressure on prices. Despite these headwinds, Tampa's housing market is not collapsing, it is normalizing. After years of unsustainable growth, the current decline can be seen as a correction rather than a crash. Inventory levels are slowly rising, giving buyers more negotiating power. Homes are staying on the market longer, and sellers are beginning to adjust expectations. For buyers who were previously sidelined, this shift could present new opportunities, especially if interest rates stabilize in the coming year. Looking forward, Tampa's long-term fundamentals remain strong. The city continues to attract businesses, particularly in finance, technology, and healthcare, which supports job growth and migration. Retirees and out-of-state movers still view Tampa as a desirable destination, ensuring a steady stream of demand. The key question is whether affordability challenges, insurance issues, and economic uncertainty will keep prices under pressure in the short term. In summary, Tampa has transitioned from one of the nation's fastest rising markets to one experiencing a measurable correction. With a 6.2% decline in median prices to $410,000, the city reflects the broader Florida trend of once scorching housing markets cooling under financial and environmental strain. For buyers, this could signal opportunity. For sellers, it may mean recalibrating expectations. 10. Salt Lake City, Utah. With a current median home price of $500,000, Salt Lake City stands as one of the most expensive markets in the Intermountain West. However, The city is also experiencing a minus 6.0% year-over-year decline, signaling that a sharp adjustment is underway after years of rapid price appreciation. During the pandemic housing boom, Salt Lake City gained national attention for its skyrocketing home values. Fueled by a growing tech sector, remote workers flocking from California, and Utah's reputation for a high quality of life, the city saw bidding wars become the norm. Families from out of state brought higher budgets, pushing prices far above what local incomes could sustain. Between 2020 and 2022, prices surged at one of the fastest rates in the country, creating affordability pressures for many longtime residents. Now, however, the dynamics have shifted. Higher mortgage rates, hovering near multi-decade highs, have reduced buyers' purchasing power, cooling demand significantly. The very same households that once bid aggressively on properties are now sitting on the sidelines, waiting for conditions to stabilize. Sellers, on the other hand, are struggling to adjust expectations. Many still list homes at pandemic-era highs, only to face longer days on the market and eventual price cuts. The result has been a clear market correction. Inventory in Salt Lake City has risen steadily, giving buyers more options and leverage in negotiations. Homes that once sold within days are now taking weeks or even months to close. This shift is particularly noticeable in suburban areas like South Jordan, Draper, and West Valley City, where oversupply is beginning to put additional downward pressure on pricing. At the same time, Salt Lake City remains economically resilient. The Silicon Slopes tech corridor continues to attract investment, and the region's natural beauty, strong job market, and outdoor lifestyle are long-term draws. Many experts believe the current decline is less a collapse and more a healthy reset after unsustainable growth. For first-time buyers who were previously priced out, this correction is creating new opportunities, though affordability remains a challenge given high interest rates. Another factor shaping the market is Utah's population growth. The state has consistently ranked among the fastest growing in the U.S., driven by both natural growth and domestic migration. While the short-term housing market has softened, this demographic trend suggests long-term demand will persist. Developers and home builders are still active, though at a slower pace, recalibrating to align with cooling demand. Looking forward, analysts expect Salt Lake City to stabilize as mortgage rates eventually ease. If borrowing costs decline in 2025 or beyond, pent-up demand could quickly return, especially among younger buyers hoping to establish roots in the area. Until then, the city will likely see continued price adjustments as the market works through its post-boom phase. In short, Salt Lake City's housing market is undergoing a significant correction after years of explosive growth. While the immediate trend shows prices falling, the city's strong economic fundamentals, expanding tech industry, and enduring lifestyle appeal make it unlikely that this downturn will last indefinitely. For investors and homebuyers alike, Salt Lake City represents both a cautionary tale of overheated growth and a market worth watching closely as it recalibrates for the future. Conclusion: the U.S. housing market is clearly undergoing a period of recalibration. After several years of rapid appreciation fueled by record-low mortgage rates, migration patterns, and pandemic-era demand, many cities are now experiencing a reversal. From Austin to Salt Lake City, markets that once seemed unstoppable are showing declines ranging from 6% to more than 10% year-over-year. This correction highlights the cyclical nature of real estate and the importance of distinguishing between short-term volatility and long-term fundamentals. High mortgage rates have emerged as the single most influential factor cooling demand. With rates hovering near multi-decade highs, buyers are increasingly priced out, particularly in markets where home values soared beyond local income growth. Meanwhile, sellers are reluctant to reduce prices significantly, leading to slower sales and longer listing times. This standoff has created uncertainty, yet it is also preventing a more dramatic crash. Florida stands out as a microcosm of these dynamics. Once considered a pandemic boom state, cities like Palm Bay and Tampa are now leading declines. Similar trends can be seen in Western markets such as Phoenix and Las Vegas, where speculative buying previously drove unsustainable gains. Even historically stable areas like Salt Lake City are not immune to correction after steep increases in recent years. Looking ahead, The trajectory of the housing market will hinge on interest rates, employment stability, and migration trends. If rates ease, buyer demand could recover moderately, supporting a more balanced environment. If not, we may see further softening before a bottom is reached. For investors, buyers, and policymakers, the lesson is clear. Markets cannot defy fundamentals indefinitely. The current cooling phase, while painful for some, may ultimately restore healthier affordability and set the stage for more sustainable growth in the years ahead.